The three types of unemployment. So I'll start today just briefly going over those again. So, previous slide. Yeah, so the types of unemployment can explain why, no matter how good the economy was doing, we always experience some level of unemployment. We never get down to zero. So the first type is frictional. So these are the result, remember, of the time it takes to match workers and jobs, that they're, the job openings and the workers that have the characteristics that are needed. So because this job search takes time, there's always going to be some unemployed people in the economy. Not that there's something bad going on. It's usually good that there's some sort of time it takes to match up, because you want people to find jobs that actually meet their skills, rather than people taking the first job they can find that they're really not that good at. It won't be good for them because people don't enjoy jobs they're not very good at. And it's not good for the companies because they're being less productive. They have less productive workers. There's also seasonal unemployment that occurs, that at different times of the year, different industries will have higher or lower demand. So like retail workers, a lot of demand for them around Christmas time, a little bit less the rest of the year. Farm workers, they want more around harvest time, and then less the rest of the year. So the BLS, when they release unemployment numbers, also includes seasonally adjusted numbers that get rid of those fluctuations due to just the time period that we're looking at. It's not that those people don't matter or that their unemployment doesn't matter, but policymakers, there's no way for them to affect the seasonal unemployment. So if they're trying to look at the underlying trend in employment in the economy, you want to get rid of that stuff that you know is going to happen every year, and that you have no way to affect. Next type is structural unemployment. This is unemployment that arises from this mismatch between workers' skills and between the job openings. And when people suffer structural unemployment, it takes much longer typically than the frictional unemployment. The reason being that they don't have the proper skills to find these jobs. So they'll be unemployed a lot longer until they actually find either a job that still requires those skills, or until they're able to get retrained. The most common one, especially, it's been talked about a lot the past 5 years or so, has been workers in dying industries like in coal and in like steel manufacturing. Those are like the two big ones that people talk about. Part of that's due to foreign competition. Part of that's due to just the fact that it takes fewer workers to produce the same amount as we did in the past. So we have a lot of people losing their jobs in those professions, and they end up being structurally unemployed. Their skills don't match the current jobs that are needed in this economy. And that's why like that learn to code thing was a meme a while back. People complain about their job losses. There's a little bit of truth to that you need to have the skills that are relevant that, that firms actually want, or you're not going to be able to get a job. And finally, now we're picking up with new stuff, is cyclical unemployment. So this is unemployment that's caused by a business cycle recession. So typically, cyclical unemployment is very low as the economy is doing well, as GDP is increasing. But then once we experience a recession, when GDP falls, we see cyclical unemployment increase. So it's not due to workers having skills that don't match the jobs that are out there. It has nothing to do with the friction and the time it takes to find a new job. It has to do with how the economy overall is doing. So typically during a recession, people spend less money on goods and services. So what firms are going to do is reduce their employment to reduce their labor costs. So they'll lay some people off. And that's where this cyclical unemployment comes from. And then once the economy starts doing better, people start spending more money, buying more goods and services, firms will start hiring those workers back. So we can get cyclical unemployment down to zero. You have no people that are being laid off, that have lost their jobs because of the economy performing poorly, because we've entered a recession. But we will always see people with frictional unemployment or structural unemployment. So when all the unemployment is due to those first two, and there's no cyclical unemployment, we say that the economy is at full employment. So full employment doesn't mean zero unemployment. It means there's no frictional there's only frictional and structural unemployment in existence. There's no unemployment that's due to how the economy is performing. So because of that, we're always going to experience some unemployment in the economy. That's always going to be present with us. Economists call this the natural rate of unemployment. So this is just the unemployment that consists of frictional unemployment and structural unemployment. So we can compare to where we're at to the natural rate of unemployment to understand how well the economy is doing. So if we're estimating the natural rate of unemployment is 3.8%, and the unemployment rate is 4.8%, we know we can get the unemployment rate down by 1 percentage point. We can drop down to 3.8%, and that's about all the lower we're going to get. This was written in 2017, and at the time, economists basically agreed that the natural rate of unemployment was about 5.5%. There's no direct way to actually measure this, so they have to estimate it using several different methods. And most of them came out to be about 5 to 5.5%. But the unemployment rate dipped below that. It got all the way down into like the mid threes before the coronavirus. So for at least for some time, we were above what they estimated to be the natural rate of unemployment. There were a few economists that estimated the natural rate of unemployment was lower. It was closer to the between 3.8%, like 4.2%. But not too many economists agreed with them. No, that's the only slide on this. Okay. So the natural rate of unemployment is also called the non-inflation accelerating rate of unemployment. So there's our marker. It's abbreviated by NARU. Wow, of course, this is the one left in here. The basic idea of the NARU, the non-accelerating inflation rate of unemployment, is that if you try to reduce the unemployment rate below the natural rate of unemployment in the short term, you can get below it. If you use the Federal Reserve's monetary policy, which we'll hopefully get to talk about before the end of the semester, you can get it down below the natural rate in the short run. But because of frictional and structural unemployment, in the long run, it's going to come back up to the natural rate. So what you end up with as a result is higher inflation. You end up increasing inflation. That's what's necessary to push it below the natural rate of unemployment in the short term. But then you don't end up with the increase, or I guess the decrease in unemployment rate for very long. So you get the natural rate of unemployment, you end up back there, and you end up with higher inflation. And part of the reason is that when there's very low unemployment, firms can't just hire unemployed workers. They have to entice workers to leave their current employer by typically offering them more money or greater perks. So what that's going to do is higher wages cause higher labor costs, which get filtered into the prices of goods and services. So that ends up causing inflation. So in the long run, you can't go below the natural rate of unemployment. And this idea of the natural rate of unemployment was developed by Milton Friedman and Edmund Phelps. They actually were working separately and came up with the idea and published on it about the same time. Phelps is a heavyweight of macroeconomics, and so was Friedman. Friedman actually won the Nobel Prize in economics for his work on monetary economics.
What does that stand for again? What's the I?
The non-accelerating inflation rate of unemployment.
And what's that AKA? What's the natural?
Yeah, that's the natural rate. This is just another name for it. That kind of highlights that if you try to go below the natural rate, you're going to get inflation. And you're not going to get lower unemployment. Okay, we'll skip this JP Morgan example. I don't think that's a very good example for what we're talking about. So now we'll briefly end our unemployment talk, breaking down a few of the categories and things that cause unemployment. Different government policies that attempt to influence it directly, and some that have side effects that influence it. So the federal government has a program called the Trade Adjustment Assistance Program. And what they do is they offer training for workers whose firms laid them off as a result of competition from foreign firms. The goal of this is to reduce structural unemployment. when they're laid off, say from competition from foreign steel manufacturers, they provide them some sort of training for other professions that are much more in demand. So it helps reduce the structural unemployment because you're now giving these workers skills that match up with the jobs that are being required in the changing economy. Because remember, over time, industries are created and other industries are destroyed. So we constantly need new skills for workers to work in these industries. There are some problems with these government retraining programs of the government determining which professions, which industries are going to have increased demand in the future. Whether it's individuals deciding on their own how they want to be retrained or whether it's the government deciding, there's always going to be mistakes made. Sometimes they won't recognize industries that are going to do well in the future. Sometimes they think industries are going to do well in the future, but I don't know, they end up not taking off. So there are problems of actually picking the winners. But it is a great way to reduce structural unemployment because you're improving these skills. You're helping workers get these new skills. And you're doing so in a cost-effective way. There's some other policies to reduce frictional unemployment. So for instance, they'll subsidize new hires. Do that just to make it easier for firms to bring in new workers because hiring workers is an expensive process. Actually going about and finding, bringing in all the potential employees, interviewing them all, sitting down discussing who's going to be the best. It can be an expensive process for a company. And it's very time consuming. I was involved in the new hiring process for a new professor recently, and a bunch of meetings, a lot of time. You had to fly out to San Diego to interview him, which was actually really nice. But I wasn't paying for the ticket out there. So anything the government, by providing some subsidies, helps reduce these costs, makes firms much more willing to hire new workers. But there's other government policies that increase the unemployment rate and do so as side effects. There's some things like unemployment insurance, minimum wage laws that increase unemployment. So for unemployment insurance, just imagine that you've been working for a while and you lose your job. So you want to find another job, and you've got two options. You can take a new low-paying job immediately, go out, find the first one that's advertising new hires, step in and do that so you don't have to miss out on any income, go with zero income for a while. Or you can take your time and search for a better job, something that actually matches your skills, and go through that much longer process. Because the higher your salary is going to be at a position, the more time a company wants to take to know that they have the right person. But if unemployment insurance is available to you, so if you can get money to tide you over while you're searching for a new job, you're probably going to choose the second option. You don't need to take that first job that offers you any money. You can wait for something that's actually good and wait for a higher salary. So you'd be more likely to wait and take that time, which is a good thing, but it's going to increase the unemployment rate because you're going to be out of work for a while. In the US, unemployment insurance is fairly generous, but it's not generous compared with other high-income countries like countries in Europe. And we have normally relatively short time limits. Like I mentioned, I think it was last class, during the recession, for a couple of years afterwards, we extended unemployment insurance so that workers could be, they could have some income while they're waiting for the industries they worked in to recover. Some of the idea was that, the housing sector took a huge hit. A lot of construction firms laid off a ton of workers. But the expectation was, even if it won't recover in the short run, in the long run, it is going to recover. So instead of having these people take new jobs in other industries and have to retrain, and then later on we have a shortage of potential workers in the construction industry, just tide them over until the industry recovers. It definitely helped workers and people that were out of work, especially as we struggled to improve the economy after the recession. But it increased the headline unemployment rate. So we saw higher numbers for unemployment rate. Not necessarily saying it's a bad thing, but saying that this is part of the cause of those numbers. And interestingly enough, in Europe, their unemployment benefits are more generous, and they have higher rates of unemployment. So these are kind of related to each other, that the opportunity cost of being unemployed is much lower in Europe because they're receiving these more generous benefits. But again, you have workers who are willing to take more time so they can find a job that's better for them. The next is minimum wage laws. So when the first minimum wage laws were introduced, they were 25 cents an hour. This is back in the 1930s. So the cost of living was extremely cheap. You ever had your grandparents or my great aunts and uncles talk about how they could buy stuff for a penny? Everything was super cheap back then. Today, the minimum wage is much higher. The federal minimum wage is $7.25. And a lot of states and cities are moving up towards $15 an hour. Study suggests that a 10% increase in the minimum wage reduces teenage employment by about 2%. So you're reducing the number of people that are employed because you're making it more expensive to hire these workers. So you end up with a small effect on unemployment. It may not be a huge driving factor of the unemployment rate, but this is something that increases the unemployment rate. And again, that's nothing to say about whether minimum wage laws are good or bad, just to say that it does have this effect on the unemployment rate number, the actual number you're looking at. Unemployment rates, or studies on minimum wage laws, are very difficult to estimate accurately because a lot of times we don't have data on individuals that are actually making minimum wage, so we can't track and see what happens. So we try to use different industries where a lot of workers are paid low wages as like a proxy for that. So some of them look at just like the fast food industry, look at employment in the fast food industry to get an idea. After the Seattle $15 minimum wage, they had some fairly high frequency data, employment data that was like detailed enough that you could pull out workers that actually make minimum wage, and we could see what happened over time. And I forget the exact effect, but we saw it did what you would expect, it increased the unemployment rate. But this came out after the last time they updated these slides. And obviously looking at just one city, it's tough to use that model to estimate the effect for the entire economy. There's a lot of different things going on between cities like Seattle and cities like Evansburg, Pennsylvania. Next is labor unions, and I'll include occupational licensing with labor unions because it's a fairly similar idea. Labor unions, organizations of workers that get together, they collectively bargain with their employers to get higher wages and better working conditions. When we think about labor unions, often we think about late 1800s, early 1900s, the actual literal fights between labor and the owners of these businesses. The rate of unionization has substantially fallen in the United States. It was up in the upper 20s in the 1940s, but it's fallen about 9% today. So we don't see a huge effect that unions have on the wider economy. Basically how unions would increase the unemployment rate is that they increase the wages of union workers. So again, you're increasing these labor costs, you're going to see fewer people employed. And that's basically the same effect that occupational licensing has. Occupational licensing has increased from about 5% in 1950 of workers to about, depending on your estimation, 25, 28% of workers today. And they erect these barriers to entry to make it difficult for workers to get into these professions. They increase the cost of entering, so we see fewer workers work in these industries. A lot of times we think about professions that are licensed as being like physicians, healthcare in general, dentists, lawyers. But in fact, there's a lot of lower skilled occupations that don't require college educations that license workers and require them. So things even like hair braiders, you have to go to school for a year and a half in a lot of states. I think it's 35 states at this point. Learn all about cosmetology just to be able to braid hair. And these reduce employment in industries by, I think it's 14%, was what Morris Kleiner found a couple years ago. So we're seeing fewer workers. It pushes them into other industries, and it probably increases the unemployment rate a little bit. Again, not a ton. We're not talking about the entire unemployment rate being driven by any of these, but small things that are adding to the unemployment rate. The final is efficiency wages. So firms typically like to pay the market wage. They don't want to choose to pay above that when it's going to cost them extra money, but sometimes they're going to. So firms may want to get the best performance they can out of their workers, so they'll pay them relatively higher wages. Especially for services, it's a lot more difficult to monitor workers than it was for traditional manufacturing, where you could just count how many things they were making. So since you can't tell how hard someone's working, to prevent shirking, you pay them a little bit of extra money, give them that reward so they enjoy working there, so these will keep them motivated. And they know if they do poorly and they lose their job, they'll get paid less money working somewhere else because they're getting paid above market wage. Efficiency wage is a very small portion of unemployment rate, but still something that causes unemployment. You guys have any questions about the unemployment rate? About the things we covered the past 2 classes? This stuff is fairly straightforward, but it's important to cover all these things, understand what we're talking about when we move into talking about the macroeconomy and its performance over time. So we can break these down, understand different things that are happening. Know that there's a natural rate of unemployment that you can't go under, things like that. It'll help our understanding later. So we'll move in and we'll look at inflation next. So the last chapter, we talked about the idea of the price level when we looked at the GDP deflator, thinking that prices change over time, so you need to account for that if you want to be able to understand and compare these economic indicators over time. So the percent increase in the price level from one year to next is the inflation rate. So we typically talk about the inflation rate being like 1%, 1.5%, 2%. We talk about it in these percentage terms rather than looking at the number of the price level. I'm saying this year's price level is 114. That's kind of meaningless, so we use percentage. In the last chapter, we used GDP deflator to look at the change in the price level. This is pretty accurate. It's a good measure because it includes all the goods and services that are being purchased over a given year in an economy. But if we want to look at the effect of change in price level on consumers, what consumers are actually buying, how it impacts their bottom line, which is our main concern with the inflation rate, GDP deflator is going to be a little bit too broad. It's going to cover too many different types of purchases. So we may not get accurate results. Because we're looking at all goods and services, it includes too many purchases, like things that businesses purchase that aren't going to be purchased by regular households. So the cost of capital equipment doesn't matter to your life, pretty much. So because of that, we use an alternate measure. We're going to look at the consumer price index, and we'll briefly talk about the purchaser price index. So the consumer price index is a measure of the average change in time of the prices that households pay for goods and services. They look at the typical urban family. So the consumer price index covers people that live in urban or suburban settings, and it covers about 88% of the population. So super rural areas aren't being counted. People who live on military bases aren't being counted. People that live, the institutionalized population, which basically means like prisons and long-term care facilities. They're not being counted. They try to break it down to your typical family of 4, your average American family. I was going to break down all the things they do to actually measure the consumer price index, but it's actually really difficult. I pulled off like a 20-page PDF, breaking it down. A little too much to go over, wasn't really worth it. So we'll talk a little bit more, gloss over some of the details. This chart here has the basket of goods used to create the CPI. So they break down what the average family spends their money on based on a survey of 14,000 households. The survey goes out, people write down how much they spend each month on all these different types of sectors. So you can see here, housing takes up a huge portion of consumer spending. Food and beverages are another huge chunk. Transportation, another huge chunk. Medical care, about 7.7%. So they break down this basket, and this is to represent, what the average household pays. So then when we look at the change in the price level, or the change in CPI, we can see how it affects actual people. So when they actually go and figure out what the prices are over time, they'll do some telephone surveys where they call different places where people shop that they randomly select, and they will ask them what your prices are for these different goods and services. And they'll also send out people with clipboards so they walk in and look for the prices of goods and services. And again, this is a survey, so they're surveying households to get their spending habits. So it's not asking every single person in the country. So there may be some accuracy issues there. And they're not going to every single place that sells goods and services in the country. So there's some sampling selection there that, again, may bias our results. So these are estimations, just like the unemployment rate, rather than hard and fast numbers. And they use some fancy methods, some kind of math that I haven't heard of before, to truly get these numbers to try to match up. So again, we're working with calculation rather than actual numbers that are coming out. So in order to calculate the CPI, basically what you need is the basket of goods. So what people are actually buying in a given year. The cost to purchase those goods in a certain base year. So you pick one year as, like we talked about, GDP deflator for 2009. So you select one year, like this is the year we're looking at all the prices in. And then you look at the prices in the current year, and you compare the two of those. So the CPI this year is the cost to purchase the basket of goods this year divided by the cost in the base year that we're looking at. And then we multiply by 100 to make it a percent. So we'll look at a simple CPI calculation so this makes sense to you guys. So if we have our economy with 3 products again, eye examinations, pizzas, and books. We have the base year here, 1999, with our quantities and prices. And then we have 2016 and 2017. So with just that information, we can calculate our basic CPI for this really simple economy. So we take our expenditures in the current year, so in 2017, take our expenditures in the base year, which is 2016, and we multiply that by 100. So our total expenditures in 2016 was 900, and our total expenditures, sum of all these, is 950 in 20. Oh, that's the one they didn't update. Wait. Oh no. We divide these by the base year, 750. So we have 2016 here, 900 divided by 750, their expenditures this year and expenditures in our base year. So that leaves 120. And we have our expenditures this year, the sum, 915, divided by 750, expenditures in the base year, times 100 is 122. So we have our CPI, the actual price level in 2016, and the price level in 2017. As you can see, the price level increased from 2016 to 2017. So to get our inflation rate, it's just going to be the percent change. So the new expenditures, 2017 expenditures minus the 2016 expenditures, divided by the 2016 expenditures. And again, multiply that by 100 because we're working with percents here. So we end up with a 1.7% inflation rate. This makes sense. This isn't something like you need to know how to calculate or anything, but it's basically to show you how we're working with this. We're estimating the price level compared to the base year, and then we're doing that for the current year you're looking at and the previous year, and you find the change from the one year to the next, so we get that percentage. And since the CPI is looking at consumer prices, we call it the cost of living index. So this is the cost of living, for people in an economy. So You hear about like COLA adjustments or COLA raises for your wages. Basically, they take the CPI inflation rate and they give you a raise based off of whatever that is. So if they're looking at your wages for going from 2017 to 2018, they estimate the unemployment rate or the inflation rate 2017 was 1.7%. They'll give you 1.7% cost of living adjustment. They'll give you a raise by that much to make sure that your salary is the same as the year before. A lot of businesses do that. The government does that for workers. The government does that for the benefits that they provide people. So things like Social Security. But again, there's going to be some problems with the CPI. We find this a lot with our macro data, that there's problems with trying to estimate this. They say a model's only good as the data you're working with, garbage in, garbage out. So it's important to remember these shortcomings so you don't try to precisely estimate these things when you don't have the data to precisely estimate it. So the first problem is the substitution bias. So over time, consumers change their purchasing habits. Sometimes they'll change away from goods that have increased in price. Again, when there's a good out there with a lower relative price, odds are they're going to purchase that more than they will the higher price good. Through the survey, the CPI doesn't update the consumer basket very often. In recent years, they've had to increase how many times they change a basket because they have a lot more like new electronics coming out that weren't being counted for long periods of time. So we're getting inaccurate measures of what people were actually buying every month. It's also difficult to capture the increase in quality. Very difficult to try to measure that. It requires some sort of subjective valuation. So how do you separate improvements in quality from an increase in price? So cars are becoming much, much safer. So how much of the increase in price of a new car is due to the increase in quantity, in quality of that car? We've got these new safety features, maybe it's more fuel efficient, maybe it'll last longer. How do you separate that from just a change in the price level? And the same thing with computers. Computers, phones, these electronics can do so much more now than they used to be able to do. How do you actually estimate that? How do you pull that out and know which is quality and which is just price level? There's also the new product bias. So if you're changing the basket of goods every 10 years, and there's new products being invented and being sold within that time period, you're not going to capture that in the CPI. So it took them like 2 decades to actually start counting cell phones as part of the CPI because it was invented before one of the changes of the basket of goods. And then even after that change, there weren't a lot of people buying them. But eventually, once the price came down enough, the quality was high enough, demand for them exploded. And finally, there's the outlet bias. CPI uses full retail prices, but a lot of people now, they go places like Sam's Club or Costco, they buy in bulk at discounts, or they go online and purchase things much cheaper through like Amazon or through other outlets. Those places aren't sampled in the CPI, so we're overestimating the price because we're not looking at these other cheaper ways to get goods. So because of this, we believe the CPI overstates true inflation by between 0.5 and 1 percentage point. Because of these difficulties that it's really hard to adjust for, we end up overestimating the inflation rate. Right. There's the idea of the producer price index. I won't go too into detail on this. Basic idea is that it's the average of prices received by producers of goods and services at all stages. So it's like the CPI, only we're looking at what firms are actually buying and the price change for firms. So the basket of goods is going to be what the firms are buying instead of what consumers are buying. While the PPI doesn't help us with consumer prices, we don't know how consumers are being affected by this because we're affecting firms, it can give us some idea of future movements in consumer prices. So the idea being that when the cost of production goes up for firms, eventually that's going to come through as higher prices for consumers. So it's a way to estimate future consumer prices. Another thing people look at or economists look at, is just labor cost at wages. You see wages increasing. It's likely that you're going to see higher inflation in the future. Okay, we're going to skip over this price index and actually calculating that. We'll just hit a few more topics. So nominal and real variables. We talked about this before with GDP. So wages, anything that's in current year dollars are nominal variables. They're not adjusted for inflation, so it's the actual number this year. If you want to compare over time, you're going to want to use what we call real variables, or variables that are adjusted for inflation. So if you want to compare GDP across time, you want to look at real GDP. So you separate out the changes in the price level, and you're only looking at the underlying changes in productivity or whatever's driving these changes in GDP. And on that note, when we look at interest rates, which we're going to in the future in this class, we need to separate nominal interest rates between real interest rates. So let's say you lend money to your friend and they agree to pay you back with like 6% interest. So if you give them $1,000 loan, in a year they'll give you back $1,060. Do you think that's good? You know, you're making more money than if you had just held on to that the entire time. But that's the nominal interest rate. If the cost of living increases over that time, then that $1,060 won't be the same as having $1,060 this year. So if the inflation rate was 2%, then your real interest rate on that loan is only going to be 4%. So it's as if you're being paid $1,040 instead of being paid back $1,060. So it's important to think of the real interest rate, so the interest rate minus the inflation rate, when you're trying to decide whether the interest rate on that loan is worth it. Right now, it's not a big deal because inflation has been so low for so long, but I don't know what their mortgage rate was. Well, my parents took out a mortgage in like 1993. The inflation rate, the expected inflation rate were much higher. So interest rates were really high. So for their house, they might have paid like 20% interest, nominal interest. But the real interest rate was much lower. Inflation was higher back then. Let's say inflation, probably like 6% at the time. So they're paying 21% nominal interest rate. The real interest rate was only 15%. So it was much lower than the nominal interest rate would have you believe. Yeah, we can see these changes over time. If we look back here in the 70s, so this first decade or so, you see nominal interest rates are very high. Real interest rates are very low, and some years negative, because the inflation rate was so high. So even though nominal interest rates are up over 15% some years, because the inflation rate was double digits, the real interest rate was actually pretty low. We see nominal interest rates fall to basically zero here after the financial crisis. But we had some inflation. So the real interest rate was actually negative. Okay, so sometimes inflation can seem unimportant. So if all prices doubled overnight, nothing much is going to change. Even though the prices of all the goods and services would have doubled exactly, so would your wages. So really, you're just changing the number of zeros you're using when you're paying for something, or the pictures of people on the dollar bills that you're spending. Speaking of Kennywood, there's a really good paper from I think the 1960s talking about this idea of the change in price level that uses Kennywood as an example. Because do you still have to use the special money in there that's I think it's tickets. What's that? Not sure, but he talked about if you doubled the number of tickets, what would happen? And basically nothing. Like this first example, everything's more expensive, but you get double the tickets, so it doesn't really matter. But the problem is not all wages, not all prices rise at the same rate. So if we have this massive inflation, we have a larger inflation than we have right now, some people are going to have their real wages increase. Some people are going to have them decrease. If the increase in your wages is less than the increase in prices, you're going to see your purchasing power decrease or your real wages fall. And there's people on fixed income like retirees where inflation hurts them particularly hard because their purchasing power falls as the prices increase. And not all goods and services are going to increase uniformly. So some goods are going to have their value increase by a lot or the prices increase by a lot. Some will have their prices increase by only a little bit. So because not everything is increasing perfectly, we have these problems with inflation. It also makes it difficult to make future purchases. And when inflation is higher, there's more variation in our expectations of what inflation is going to be. When people don't have an accurate anticipation of what inflation is going to be, it makes it difficult to plan these future purchases. So people and firms have increased costs of holding cash. If there's inflation and you hold on to money, literally like stuffing it under your mattress, or if you put it in a bank account, like a checking account with no interest, what's going to happen is if you don't spend that money, its value is going to decrease over time. So it's basically like a tax, penalizing people for saving money. There's also the idea of menu cost. So for firms to change their prices, there's often some cost associated with that. So you imagine a restaurant and they have the prices on all their menus. In order to increase prices, they have to get rid of all those menus and print new ones. Sometimes you'll notice they'll white something out and write over top of it. But oftentimes, nicer restaurants like to print new menus every time. So it's going to increase the cost of just operating for firms.
Rite Aid started doing a rebranding, and so we're going from like the red and blue logo to a blue and green. So we have to get new shirts, new name tags, new bags, and all of new stuff.
Very similar to this menu cost.
Yes.
That's more about branding than about the actual things. But that's exactly what they have to deal with. They have to produce all these new things in order to show off these new costs, and it's expensive.
Yep.
That's why you don't see firms change their branding and logos more often. And another side note, investors are taxed on their nominal returns rather than real returns adjusting for inflation. So inflation can increase the tax due to investment. And when you penalize investment or make it, you lower the benefits of investment, it makes it more difficult for firms and individuals to be able to borrow. So it holds down hurts the financial system and holds down growth in the long run. You also find it hard to make good borrowing and lending decisions when you have this unanticipated inflation. So back in 1980, banks are charging 18% interest on home loans, even more oftentimes if your credit rate wasn't really good, because the rate of inflation was so high, and they were anticipating it to only increase. So people who bought homes were locked into really high interest rates, even when inflation subsided and fell to 7% by the end of the decade. Just to note, if you're buying a house in the future and you don't know, should I get an adjustable rate mortgage or a traditional mortgage where you're locked into the rate, look at the inflation rate and how interest rates have been moving. If interest rates are low, you lock that rate in. If interest rates are high, you get the adjustable rate so you can refinance down in the future when interest rates drop. There'll probably be a while till you guys are buying a house. But just something to keep in mind is to pay attention to where interest rates are so you can save money. On the other hand, if banks lend money at a low rate and then inflation takes hold, so back in the 1960s, there was much lower inflation. So banks lended then, and then they saw inflation come afterwards. The real interest rate they may be receiving could be 0 or negative. So the rate of inflation makes banks wary of lending if they think it's going to increase. Another thing it causes is, basically this caused the savings and loan crisis of the 1980s. There were these financial institutions called savings and loan. Very simple. People put their savings there, and they loan it out. When the inflation rate was rising and they were locked into these interest rates that they were paying, what they had to do was what they call chase yield. They had to go after higher and higher returns on their investments, because if not, they'd be losing money. So they invested in riskier and riskier assets, and at a certain point, when the value of those assets fell, a lot of the savings and loans went bankrupt. They ran out of money. So we saw a wave of failures for these savings and loan institutions because we had this inflation rate, this higher inflation than they were anticipating. So while you may not be you might not cry too many tears over banks failing, I mean, really no one does. It has real effects for the economy, having institutions go down like that. All right, and we'll end with a talk about deflation. Why is deflation bad? Your book takes a much more negative position than I think they should take. They say deflation is dangerous for an economy. Let's use an example for this. This is what happened during the Great Depression. So if you know the car is going to be cheap next year when you're considering buying one, odds are you're going to wait. Say, hey, you know what, I'll buy next year, I'll save the money. But if everyone does that, a lot of people wait to buy a new car. Firms going to see their demand this year drop by a lot. As they take in less and less revenue, they can afford less labor costs, so they'll lay off more people. As they lay off more workers, fewer people are going to be willing to buy their automobiles. Fewer people buy those automobiles, firms take in less money in revenue, they have to fire more workers to reduce their labor costs, and we get in this vicious cycle of prices falling over time, unemployment rising, and things doing worse and worse. So when we see deflation due to aggregate demand, that's a bad thing. When workers don't want to purchase as much, deflation is bad. But when the price of a television goes down from last year to this year, because, I don't know, a new TV came out, because they're better at producing these new TVs, that's a good thing. So when we have supply-driven deflation, the price of these goods and services falling because firms are more productive, this is a good thing. So it's important to recognize the difference between these two types of deflation. And the Federal Reserve, the reason they set their inflation target at 2% is that they want very stable prices, but they also want to avoid deflation. So they set a little bit above zero. So if they miss and they go a little bit lower than their target, we're still not going to fall into this deflationary spiral. Shit, it's after 12:50. All right, so we didn't get a chance to cover the review sheet. So